Hi, this is Sarah from In Accountancy and welcome back. Today we're going to continue talking about the new corporation tax regime. That's not very easy for me to say at the minute, I need to put my teeth in. So the new corporation tax regime that came into place on the 1st of April 2023. So hopefully you've watched the last video which took you through this example of how the new corporation tax with its small profits threshold and its marginal rate bands and its main rate band of 25% will impact company A that has a £200,000 profit. So if you haven't, flick back and have a look at that, because now I'm going to talk to you about what happens if you have more than one company in which you are the major or majority interest. So you might want to capture this and remember that company A here, a trading company where there's only one company, has a profits of £200,000. Under the old corporation tax regime, it would have paid 19% on all of those profits, resulting in a corporation tax liability of £38,000 for that period. Now, under the new regime, company A would see the first £50,000 of profit being subject to 19% corporation tax, and then £150,000 worth of profit being taxed at 26.5%, which results in a corporation tax liability of £49,250, £11,250, or almost 30% increase in corporation tax on the previous year. Not for the faint-hearted, not to be sniffed at. Now I'm going to clean this off and I'm going to talk you through what happens if company A is a trading company and the same owners also have a holding company in which they hold the property from which the business trades. So we're going to call it Holdco A, and we're going to see what happens if that company has profits of £40,000 and is subject to corporation tax. So bear with me and I'll be back in just a minute. So I'm back. So I mentioned that we're going to have company A is going to have a holdco. We'll call that Holdco A. But for now, we're just going to talk very quickly about associated companies. Now, the reason that the associated companies rules exist is that we saw here with company A that there's a 30% corporation tax increase from the pre-2023 corporation tax rates to the post-2023 corporation tax rates. Now, that people won't be happy about that. A lot of people won't be happy about that. And when people aren't happy about a big tax hike, what some people naturally want to do is see how they can reduce that tax. So they might think about perhaps splitting their company. So for example, if company A were to divide its business into four, say for different products to run through different business limited companies rather than just different income streams within the same company, they could have potentially 4 companies at £50,000 each profit, and therefore they'd only pay the 19% corporation tax, and they'd save themselves £11,000 or 30% increase in corporation tax. So might be worthwhile doing, but it's for exactly this reason that the associated companies rules exist, to stop people evading tax by splitting up their companies, essentially, which is all well and good, but then there are other businesses that will get caught by this as well. So let's get rid of that. And the associated companies rules mean that essentially these thresholds are divided by the number of companies in which you have a controlling share. Now, I'm not going to go into all of the details at this point as to how you work this out. It is complex. it sounds like it should be very, very straightforward, but it is complex, and it does involve overseas companies, and it does involve joint ventures, and it does involve group holdings and so on and so forth. So do take advice, because it is not always as straightforward as you might need to think. But this example is very straightforward. So we have said that we have got company A, which is the trading company, and then we've got holdco A, which holds the property, and it has a profit of £40,000. So in the standard example, even in from April 2023, if this company was the only company that these individuals owned, then this company would see corporation tax at 19%, which is 7,600. I'll write that down so I remember it. That would be CT 19% is 7,600. So that would or should be the corporation tax liability for that company. And here, remember, it was 49 to 50. Okay. However, now we've said that this the thresholds get divided by the two companies. So instead of the small profits threshold being 50,000, it becomes 25,000. Yeah. Then the marginal rate band is profits over 25,000 and below £125,000 of profit, which means that the 25% corporation tax kicks in at £125,000. Sorry, my writing is awful, but hey ho. You get the gist, I hope, and the subtitles will explain it a little bit more clearly, or at least not in my handwriting. Okay, so what does that mean then for these companies? Well, company A is very, very straightforward to work out, because everything is taxed at 25%. So the corporation tax liability for the £200,000 of profit is a simple £50,000. So it's a small increase. It's only £750 more than it was previously, but it's still £750 more than if they only owned one company. Company or holdco A has a trickier time, and because holdco A now falls into this marginal rate band, so holdco A will have 25,000 at 19%, and it'll have 15,000 at 26.5%. So that half of what it was previously is 4,750 plus 26.5% of 15,000 is 3,975. So that is 8,725, which is an increase of it's an increase of £1,125 on the standard 19%. So again, it's a big whack, and actually then this company, of course, across the board will be paying £1,875 more in tax, just because they happen to own another company together. Oops, can't quite see that. There we go. 1,875 in tax, as I say, just because they happen to own a second limited company together. So that in a nutshell is about the associated companies rules. Now, I've said it is complex. There are things that I've not touched on, and another thing to mention would be that actually this applies if there's even one day where the companies are associated in a tax year. So this could have huge ramifications if you want to buy a business, for example. If you already own one, you want to buy one, and there might be a period in which you are the owner of two companies before it merges into one, both of which are subject to corporation tax. This will hit you there as well. You may have 3, you may have 4, you may have 5. It keeps decreasing the more companies that you have. So I hope that has explained it in as simple a way as we possibly can. As ever, if you've got any questions, please drop them down below, or feel free to contact the team. We are very switched on about what we can do to minimise corporation tax in an efficient and, most importantly, legal and compliant way. And yeah, we look forward to hearing from you. And next up, we'll be looking at certain businesses, and we'll look at Company A again, and we'll look at how much profit Company A, how much more additional profit Company A needs to make in order to just stand still and make the same as they were making last year in terms of profit after tax. All right. Hope you've enjoyed that, or at least found it useful. If you haven't enjoyed it, fair enough. It's hard to enjoy tax quite so much as I do. We look forward to hearing from you. Bye for now.